So if we see an increase in quantitative easing, which is them printing money to buy assets, then we will see interest rates potentially go down because they're acting as sort of that buyer of long-term duration debt. We'll see interest rates in mortgages come down, which will allow people to move homes and sell out of, if they're retiring, which if we look at generationally, we see that likely there's a large generation here that is needing to downsize and likely trying to create sort of backdoors for people, like their children to inherit it in a way where they don't have to refinance it at these larger, higher rates. But if interest rates on mortgages go down, we're going to see a lot more activity, which means more tax receipts, which means more economic activity for the government. So the government really wants long-term rates to go down. That also allows them easier financing for their increasing debt, which is just basically never going to stop, right? Nothing stops this train. And the only way they pay that debt off is by printing money. And the Federal Reserve is the one that prints the money. So as we can see here, there's some cracks in the system, and likely, I don't think it'll be that long. I don't think we'll go for years like we did here in 2014 to 2018 or even 2019 as it declined, of the balance sheet staying steady or going down. I think we're going to see that for a little bit, and then we'll probably see a nice pop of money printing. And I don't mean to say that it's good that they're money printing, but what that will do is that will cause inflation of assets, because when money is easy and when money is when there's more money being printed into the economy, it's increasing the supply of the asset of dollars. And if that demand stays relatively the same, then the value of that asset that there's more supply of will go down, right? So the value of the dollar will go down relative to other goods and services. The assets that will appreciate the most are the assets that are most correlated and connected to money printing and benefit from cheap debt. So think businesses that are highly indebted that can refinance. Think Bitcoin, because Bitcoin is a direct retaliation against this entire fiat system that is predicated and built on debt. Plus, it's in its adoption cycle, so it's rather speculative. And as people can have more ease of access, money goes to more speculative type bets. And that's just currently where we are with Bitcoin. Jerome Powell's speech today, what to expect as Fed ends QE. Odds of a 25 basis point cut are 87% on the betting markets, which means that not only will we potentially see with quantitative tightening the long end start to be affected by the Federal Reserve in sort of a lowering way, but we're also seeing the short end get affected as well, which again is more easy money. The lower these interest rates are, the easier money is, and the more likely we will see assets appreciate based on that alone. And with the balance sheet of the Fed, they sort of step in when there is a cracks, as I talked about. And these cracks can affect the economy in a negative way, sort of leading up to them and when they happen. And assets could be negatively affected by that. And then immediately after, all of the stimulus that goes in by the Fed buying assets and printing money to do so is all going to try to make those assets recover faster. So the most sensitive assets to inflation and money debasement are going to react first to that, even if they've gone down prior to it.